Hello, today we are solving May 2019 IAL Unit 1 question number 4. So, Willow Timber manufactures wooden products for the garden. The following information is available, but the first part of the question we can see it's a theory question. It's asked, explain the difference between inventory rotation and inventory valuation. Now, inventory rotation is a process of measuring physical movement of inventory during a specific period. Physical movement of inventory during a specific period, meaning how frequently are you able to sell the inventory and replace the inventory in a business. Now it is measured using the inventory turnover ratio given by COGS divided by average inventory. A high inventory rotation means you are very efficient and you are able to sell off quickly. A low inventory rotation means you are able to not sell so fast. So usually the method followed is the oldest inventory will be issued first to avoid any deterioration or obsolescence. So inventory rotation is going to measure the capacity of the business to how frequently it is able to sell and replace back its inventory. Whereas inventory valuation refers to the process of determining the value of your closing inventory and COGS using methods such as LIFO, FIFO or average cost methods. Okay, so you have FIFO and LIFO for the syllabus. So FIFO means it will show that it is usually going to show low COGS and a high profit. The first product that comes in moves out. Okay, it doesn't matter about the high increase in the later on prices. Whereas LIFO, it results in higher COGS. Okay, the recent goods are sold first and then the previous goods that have entered. So it is going to result in higher COGS and lower taxable income. So this is the difference between inventory valuation and rotation. I have given a link in the description to understand more about inventory valuation and rotation. Okay, you can read that first and try to answer. This is a very common